Hello dear students. In this video we'll discuss the last concept of your module 5, that is derivatives, hedge and insurance. Okay, basically hedging means, I have already told you, that is the disbursement of a risk with another person, right? So that disbursement of risk with another person means, here another person means the insurance companies. Okay, I have been started trading with any one of the derivative contract. Okay, if I am have the insurance for that particular contract, then if risk will be arised, that is loss will be arised, at that situation we can combat with the, or we can uh, compensate with the insurance companies. Okay, this is one of the new concept being developed in the derivatives segment. Okay, first of all, there is no that is, there is no provision for to go with the insurance and all, but now it's been developed. Okay, an insurance derivatives is a financial instruments that derives its value from an underlying insurance index or the characteristics of an event related to an insurance. So just I have told you the hedging, but here the concept been also shifted to as insurance derivatives also. Okay, insurance derivatives is also one of the financial instrument which is actually going to derive its value from the insurance indexes. That is, there are so many insurance companies were there in the stock market for the investment avenue. Okay, so if I am going to select the LIC, or if I am going to select the Bajaj Finserv, or if I am going to select the Apollo Pharmacy, okay, those are all going to provide the insurance for the health, and as well as certain insurance companies which will protect the interests of the public in various forms, like protecting life, or protecting the car, bike, motor vehicle, those type of insurances, or for cotton, jutes. Okay, for those kind of commodities also, the insurance will be provided. Okay, but those are all in those are all the underlying asset will be the insurance indexes. Okay, uh, insurance derivatives are useful for insurance companies that want to hedge their exposure to catastrophic losses due to exceptional events such as earthquakes or hurricanes. That is, catastrophic losses which will be going to arise means nothing but unconditional losses. We can't predict what will be our future, and right now. So if we are going to have a prediction about our future, then there will be no any problem, but we can't make prediction of that, right? At that situation, whatever the kind of a losses will be going to arise is for in any form. Okay, it may be the natural disasters, or it may be related to any other kind of a transactional issues. Those are all going to controlled or curbed if the contract is secured by the insurance. Okay, contract if insured, then there will be no any problem at all. If the contract is not insured, then it's a greatest problem. Okay, so the next is insurance derivatives versus traditional insurance. That is, traditional insurance means, as we all know, that car insurance, bike insurance, motor vehicle, and life insurance. These are all the traditional insurances. But that shiftment is happened in the year of 2020s onwards. That is insurance derivatives as well. Okay, even weather derivatives you can also find. Okay, these are all very becoming very popular in nowadays. That is through the concept of sustainable finance. Okay, there is one concept called sustainable finance. In that, these are all the emerging topics in the derivatives market. Okay, so the traditional insurance means that is life, motor vehicle, bike, those are all insurance types. But in insurance derivatives, it's a purely the underlying value which is going to derived from the indices of the insurance companies. Okay, one advantage of using derivatives in place of insurance is that the hedge is more protected from spatially correlated events such as adverse weather patterns. That is, I have told you, right? Weather derivatives also been introduced. These are all the emerging trends. Just don't confuse with the things. Okay, if for example a heat wave moving across the western United States stops electricity production at wind farms in those states, project owners may have little recourse in the geographical diversity of their portfolio. Derivatives afford project owners access to the risk sharing of financial markets, and this kind of a diversification can be better than that of a geographical distribution. Here what happens means, see, one example. It is purely relating to the weather derivatives and the insurance derivatives. In United States, there is a one project called heat waving. That is nothing but the electricity generation plant. Okay, that electricity generation plant is also have the transaction in derivatives market. Okay, but they have their underlying asset or their underlying thing is the electricity generation. Okay, based on that, they will make an insurance for that. Okay, if any uncertain events will be going to happen, then that will be insured. Okay, that is what here said. Okay. Another good point about insurance derivatives is the settlement process is typically quicker and less onerous than it is for traditional insurance. That is, in insurance derivatives, the settlement process is very easy because the risk is hedged with another person, that is insurance companies, right? That risk is adjusted with another person, so that is why here the typically it is a quicker and less onerous. Okay, means easier, there will be no any complex procedures. Derivatives pay out instantly, triggered by the movements of an index, which requires no interpretation. Okay, derivatives we can automatically know how the fluctuations or how the oscillation will takes place, right? Based on that, the judgment will be going to taken out. Okay, an event either happens or it doesn't. Insurance claims, on the other hand, aren't so black and white, and they can incur considerable processing time and costs. Here, what happens means, in certain situation or in certain time, there will be no any loss for the company, or there will be no any loss for the investor, but still they will make themselves and they will project themselves as we are in a loss situation, so they will take the advantage of this insurance derivatives as well. That is, we have lost something and we want certain compensation for it, like that they will demand. Okay, so that is why it is also one of the disadvantage and it is also one of the advantage. Okay, means this concept is very simple, that whatever the kind of things or whatever the kind of contracts we are going to make and trade in the derivatives market, for all those contracts there will be an insurance company which is going to provide the insurance for all the types of contracts. Okay, because in order to safeguard the interests of the investor, that's it, there is no any other kind of things. just in order to protect the interest of an investor, this insurance derivatives concepts being emerged in the sustainable finance concept. Okay. In once again, in class I will discuss with you this sustainable finance concept is one of the most important concept. So I'll let you know in class. Okay. So conclusion about this chapter. Risk management is required in every type of contracts, or which is required in whole the financial investment avenues itself. Okay, the derivatives market is a market where investors come to exchange risks. In a global economy with divergent risk exposures, derivatives allow businesses and investors to protect themselves from rapid price fluctuations and negative invest events. Prior to the crisis, the swaps market was not subject to an effective regulatory regime. There was an overabundance of bilateral credit risk and trades were under collateralized. As the collapse of AIG demonstrated, this inferior market structure quickly became a source of risk. As the regulatory process continues, policymakers must seek to ensure that the derivatives market is a venue to manage risk rather than a source of risk itself. Okay, so one thing here I want to quote is derivatives is one of the really I'll agree with that, that is most riskiest segment. Okay, because we can't predict the derivatives market how the price fluctuations will be going to take place. Okay, and there are lot many issues will happens like all the derivative contracts are going to be there in between the two parties. If one party is not given the consent means, then it is a problem for another party also. Okay, that is why in between of these deficiencies there is a much more advantages as well. Okay, because in the derivative market is one market where the value will be derived from the underlying asset. It's not the main commodity or main equities will be going to traded. It means derived from the underlying asset. So that is why the investor will be have the more advantage to make an investment. If they are properly educated about the investment, then there will be no problem for them. If the investor is not properly educated, then the problem will definitely arises. Okay, so I think I have given the justification for the module 5 as per me. If you have any doubts, please clarify those in your class. Okay, and this mode I have chosen because of due to the shortage of time. Otherwise there is no any other problems for me. But still, if you found any difficulties, please put in comment box and let me know, and I'll clarify your doubts. Okay, thank you.